For our Did You Know segment today, we are going to cover adjustable rate mortgages. This is going to be a full scope overview. And the reason for this, over the past 2 to 3 weeks, I have noticed that adjustable rate mortgages are now starting to provide more beneficial interest rates for their initial period. I'm going to make more commentary about the current market after I provide you with all the information about adjustable rate mortgages. So what is an adjustable rate mortgage? Back into acronym city we go. We're going to call it an ARM, ARM, adjustable rate mortgage. Plainly said, it is a mortgage that has an interest rate that adjusts, as opposed to what the lion's share of the interest rates I report out on every week. They're all fixed rate mortgages with different terms, 30-year term, 15-year term, whatever it may be. Adjustable rate mortgages operate a little differently. They do adjust over time, but not immediately. They start off with an initial locked-in period where your interest rate does not change. And it can vary. It could be as short as 3 years, 5 years, 7 years, 10 years. These are the customary years where you have your initial lock-in period. Then it adjusts. It can adjust semi-annually, which means every 6 months, or it can adjust annually. These are the two most commonly adjustable time horizons when you have an adjustable rate mortgage. How does it adjust? Great question. It adjusts based on two components. The adjustment component is what we call the market index. That means your adjustable rate mortgage, your ARM, is tied to a particular index in the market that is operating freely in the market based on how investments are going, what's going on in the market. What we're going to focus on today is the secured overnight funding rate. This is now the commonly used market index for ARMs. Previously, it was the LIBOR rate, the London Interbank Exchange. I'm butchering that a little bit, but if you look up LIBOR, you can get more information on what LIBOR was. It's not as important anymore because the market has moved away from it as a market index. Now, most commonly, adjustable rate mortgages are tied to the SOFR, SOFR, secured overnight funding rate. You can go online, you can see the history of the SOFR. That's the first component of the interest rate. The second component of the interest rate is the margin. So you have the index, and when you add the margin, that gives you what's called the fully indexed rate. That shows you at present, if you were to get an ARM mortgage, adjustable rate mortgage, you can see, all right, if my margin is, let's say, 3%, and the SOFR right now, I think it's in the 4.2 range, 4.3 range. So let's just say it's 4.2, and you have a 3% margin. That means your current fully indexed rate would be 4.3 plus the 3% margin, which gets you to 7.3%. That would sometimes, depending on the length of your initial lock period when you're applying for an ARM, could be the rate that you need to qualify with. So you don't pay that interest rate because you have a discount in the initial period. But when we work on your mortgage application, we may need to use that fully indexed rate to qualify you, because we are going to think to ourselves, and the theory behind the underwriting approach when they review your documents and review your qualification, let's say right now is the same market it is at the end of your fixed period of your ARM. Well, this is the indicator we have now, so we're going to just go based on this information. It would be 7.3%. Do you qualify for that monthly payment? If so, we're good to go. If not, it's going to preclude you from this type of financing. Next are caps. So we've established now the index and the margin. That creates the interest rate you qualify with in some scenarios, and that also lets you know what it would look like when you're done with your initial lock period. The next component to consider are what they call the caps. Now, the caps on ARMs are dictated when you identify the loan program. So if I'm going to present a client with an adjustable rate mortgage option, I'm going to inform them of what the caps are. And the caps are applied to what your initial interest rate is. And this is how they operate. You may see an adjustable rate mortgage promoted, like we talk about every week, the 7.6 SOFR adjustable rate mortgage. The 7 means you have a locked-in interest rate for 7 years. The 6 means you have an adjustment after the first 7 years. You have adjustments on that mortgage rate every 6 months. So every 6 months, wherever the secured overnight funding rate is, that plus the margin is the interest rate that you will be paying at that time. There are caps, though, for the protection of the borrower and for management of the financing. And the caps are normally outlined as three numbers with slashes between them. So, for example, in this 7.6 SOFR ARM, let's say you see 7.6 SOFR ARM with 2/1/5. The first number, that 2, that indicates the cap at your first adjustment. So at the end of 7 years, whatever your interest rate is from that initial locked-in period, it cannot be more than 2% more than what that current rate was that you were repaying at for the prior 7 years. So that's your initial cap. So it adjusts in that initial, the first adjustment after 7 years, that's your new interest rate based on the index and margin. Then the 1, we said 2, 1, 5. Now the 1. The 1 is there for subsequent rate changes for your adjustable rate mortgage. That is the cap for each adjustment. So now moving forward, let's say market has not changed at all. Or even better, let's be optimistic about this. Let's say you have a 7.6 SOFR and it has a 2, 1, 5 with the caps, and your initial adjustment actually goes down. So the cap doesn't apply, right? Let's say now your interest rate is, for easy numbers, 6%. Let's say rates go down, and 7 years from now, that's what your index plus margin is. So now your interest rate is 6%. The next adjustment is 6 months later. Remember I said 7.6, 7 years fixed, every 6 months adjusting. Now, 6 months later, your interest rate's going to adjust again. Now let's say SOFR goes up. That's the only thing that's going to change your rate, what that market index does. Let's say it goes up, but it can't go up more than 1% of what you were paying at that time. So now your cap is 1%. So if you're at 6, it can only go up to 7%. That's your adjustment cap. That's that middle number. Now we have our lifetime cap. We mentioned 2, 1, 5. The 5 is the last one. That's called the lifetime cap. The lifetime cap is based on what your initial interest rate was. So let's say you had an initial interest rate at 6.5% for the 7 years in your repayment. If you had a 6.5% interest rate, add 5 to that. That means your mortgage rate can't be more, I know, yikes, 12.5. Or I'm sorry, 11.5%. My gosh, early in the morning, mental maths are not working. So let's say it's 11.5. That is your lifetime cap. That means no matter what happens in the market, you will not pay more than 11.5%. Now thinking logically through this, you have a 2% cap in your first adjustment. So at most it can go up once there. Let's say worst case scenario, rates are going up. Now your rate's adjusting. So you're going from 6.5 to 8.5%. That's your first adjustment. So then we have that 6 months later, let's say it just keeps running up. 9.5 every 6 months. 10.5 next. 11.5, 3. So we're talking about 3 6-month periods that it would take to reach that max in a worst case scenario. That's just something for consideration on the absolute worst side. But the other benefit is most, and now this is, we were talking about caps. This is interest rates going up. Now let's talk about how low can you go most of the time. And I'm going to paint with a broad stroke here, but it's very important to ask this question. If you are entertaining an adjustable rate mortgage, you're going to want to ask, what is the floor? And the floor is exactly what it sounds like. It is, what is the base rate that my interest rate can adjust down to while I have this adjustable rate mortgage? I know customarily, I just assisted a client with this, the floor rate was the margin. So that assumes in a world where the secured overnight funding rate is 0, well, if there was a 3% margin on that loan, then 3% is the lowest interest rate that would be possible. So now, to recap, we have a 7.6 SOFR adjustable rate mortgage 215. 7-year initial lock period, same interest rate for those 7 years. After 7 years, it adjusts every 6 months. 2% cap on the first adjustment. at the end of the 7 years, 2% cap. 1, every subsequent adjustment cannot go more than 1% of where the interest rate was prior to the adjustment. 5, that is your lifetime cap, 11.5% if your interest rate started out at 6.5%. Clear as mud? I hope that was helpful. Now let's talk about some of the pros and the cons. Pros, let's talk about right now. This is where I'm going to give you the current market data. Currently, over the past 4 weeks, because of what was happening in the bond market, we talked about the 10, the 5, and the 2. Adjustable rate mortgages tied to secured overnight funding rate, but that's an element in the market, like I said, contextually within where people are investing and market volatility and movement all has an impact. Well, as the bond market yield curve flattened, which means the shorter end treasuries, if you're going to invest 2-year, 5-year versus 10-year, they are lower yields and they step up to 10 years. That indicates a healthy market. Longer term money gives you more yield. Well, because of this change in the bond market, the yield curve now flattened from the inversion that we had for a very long time, and that's created a market environment more conducive to adjustable rate mortgages because of how the trading is occurring in those markets. So if we're looking at that, and over the past 4 weeks, I have seen a tremendous benefit to adjustable rate mortgages, sometimes by a very wide margin. Most of the time, you do need to pay discount points up front. I did cover that in a previous episode, but I think we may revisit that soon. Discount points, for a brief refresher, are a way that you can pay up front for, it would be a premium based upon whatever the current market rates are, and it can give you a lower interest rate for that introductory period, which could make a lot of sense. And dollar for dollar could go a lot further. For the client that I assisted recently, that was the difference between having a 6.8% mortgage on a 30-year fixed, and then they were able to secure a 5.9% mortgage on a 5.6 SOFR ARM 215. It's pretty amazing. That's quite a bit of savings. They still had to qualify at the fully indexed rate, which was no problem. So that provided a tangible benefit. The cons, and this is something that I'm going to highlight and put a big red flag up. Your risk appetite should dictate whether or not an adjustable rate mortgage is the best option for you. When you get a 30-year fixed rate mortgage, you know what your mortgage payment's always going to be from the mortgage payment. If your taxes change, your housing payment can change, but your mortgage payment is going to stay the same. With an adjustable rate mortgage, you are now opening yourself up to changes. Now, thinking about the market, everyone's had expectations for lower interest rates, probably for a little too long. And looking out further, we can't even tell. We do this on a weekly basis. We don't know where interest rates are going to go next week, next month. How could we know where they're going to go in 3, 5, 7 years? But we know that we are in a high inflationary environment right now. The Federal Reserve is very involved, and the market is waiting on their beck and call for whatever information and guidance they provide, what their monetary policy reflects. So expectations are this is an inflection point, and this is not something that is normal due course. Well, when inflation comes down, the expectation is lending rates should, go down. If you get an adjustable rate mortgage, you may be leveraging to wait for rates to come down, and you could catch that. So like I said, some of the adjustable rate mortgages, if you understand what the floor is, you may be able to get a lower monthly payment in the future without refinancing or anything because you have an adjustable rate mortgage. Best case scenario. Worst case scenario is rates go up. And 5 to 7 years from now, that's a long time. We don't know what that market looks like. In the initial lock period, you can refinance. So let's say 3 years from now, mortgage rates for 30-year fixed matches what your current adjustable rate mortgage is. If it makes sense for you to refinance, you can do that. But you got to exercise good judgment. Adjustable rate mortgages introduce quite a bit more intricacies and more for you to consider when you're making your decision for your financial planning and for management of that mortgage moving forward. So there are pros and cons. Pros, quite frankly, a little bit more immediate than looking at the long-term pros. And the cons, not quite cons in the immediate future, but there could be detractors to that in the long term. So it's very important to understand these things, and it's very important to have quality conversations with your mortgage professional. This is something that I would very much encourage you to reach out to me on. I'm going to give you my email right now, peter.d'angelo@rate.com. If you've been a home buyer and affordability has been a challenge for you, particularly if you're a first-time home buyer, let's talk. Let's talk about adjustable rate mortgages, see if your risk appetite is appropriate for it, and maybe this is something that can help you with that affordability to get more buying power and be a little bit more effective in the current market.